And before we start, make sure you hit subscribe, like the video as well, so that I pop up in your YouTube feed more, because you really want to maintain your trading edge. And by watching what I say every day, you're going to have a much better chance of doing that. Yesterday was a packed day for European inflation numbers, so we're going to check out what was going on there. And US GDP has been revised higher than expected. We're going to look at that and the upcoming inflation data coming out today. And the trading takeout today is why you have to focus on dividends reinvested when you're looking at index returns. Yesterday, we had a ton of European inflation data drop. And we started off the day with the German states, actually, at 6:30 in the morning. So we had, do you know what? I can't remember the name of this state. And I used to do German at school, and this was one of the ones that used to always crop up. But basically, this German state, the actual on the month was negative 0.3%, with the previous negative 0.1%. So pretty much in deflationary territory on a month-on-month basis. The year-on-year was 3%, with the previous at 3.1%. So disinflationary on that metric. And then if we move over to the Spanish data, big miss in Spain. So negative 0.6% month on month, with the expected negative 0.1%. And that is on the flash metric. And then here's the other states in Germany. So pretty much all misses across the board by a big amount as well. So Baden-Baden, I believe that's the name of it, 4.1% versus 4.6% previous. I'm not even going to try on these other ones, but you get the picture. There's big misses there in Europe. And, you know, to be fair to them, the EU economic sentiment remained relatively stable as well, which is bizarre. But I mean, contrasting to the industrial sentiment, it's a little bit different. And then we had the Belgian CPI as well, ticking not too great, basically. But the big one was the German CPI preliminary number, which can be revised. But obviously, judging from the previous numbers, we can see that was always going to be a big hit. At negative 0.4% on the month-on-month, with expected negative 0.1%. And the year-on-year at 3.2%, expected 3.5%. So Germany is currently leading the race in the disinflationary wars, if you like. And I mentioned the euro yesterday, mainly due to the expectation that, you know, the market would start to come off a little bit. Now, if we go and have a look at the euro, we can see that trend line that I mentioned yesterday is being rejected currently, and we're looking at a relatively strong end of week bearish impulse. So what you tend to want to see is a key high break and then the market close below. And that's effectively what we are shaping up for anyway at the moment. And the fact that it's at, you know, this major 15-year trend line that I always mention, I've been mentioning for the last couple of months, says to me that there's the potential for a regime change. Now, we might need to see some further impulse, but what I like to say is confirmation is for Christians. If you think there is a strong enough reason to get into the market, then have a go. You know, limited risk. Absolutely limit your risk initially. I'm a big believer in scaling into a position, but whenever I hear people talking about, oh yeah, you need the market to confirm, it's like, well, you don't, because the market's going to move anyway. So that's what I like to say. Confirmation is for Christians. Confirmation is not for traders, because by the time the move is confirmed, you've already missed enough of it, and the risk to reward diminishes, and you get into a weird limbo of execution. So the best way to counteract that is just to limit your risk on the initial entry. Feel what the market does, feel how the market makes you feel as well. And if it starts moving in your way right away, you tend to have a good grasp on whether you can add more further down the line. Now, this is probably going to be influenced as well, the euro, by what's happening later today, which I'm going to get onto in the next segment, which is US CPI. If that comes in strong, then you should see a nice impulse through here. But we'll move on to that in the next bit. I think looking at any further data today from Europe. Let's just have a quick peek back. Let me just change the date on this. Sorry. We've got the EU unemployment rate at 10 a.m. UK time, and then we have. That's about it. I mean, we've got Lagarde later today on banking resilience, but not huge. So, yeah, I think today is going to be a very much a US driven day. Focus on US news coming out after lunchtime UK, and make sure you keep it tight. So, it was actually a very surprising day in the US yesterday because of the US Q3 GDP second estimate, so the more accurate estimate. It came in at 5.2% on the actual, whereas the previous number was 4.9%. And I'm thinking to myself, well, how? Everyone's talking about a recession. But the reality doesn't necessarily match up with what people perceive things to be looking like. Yes, credit card spending is higher. Yes, that's a warning sign, but it doesn't mean anything. If credit card spending were to completely contract, it means that people have blown up, and you have to then match up things like credit card spending with defaults. Defaults are higher, but not at a unsustainable level. So the American consumer has a lot of revolving credit still left. This is one component, in my view, as to what's driving this GDP boom. You've also got earnings growth being fantastic, showing a strong, I guess, American consumer, but also to an extent a strongish global consumer, even if global consumption is declining. Or at least what that might mean is that there's a strong sense of demand for US products from US companies and US services. So this is what we're seeing at the moment. We haven't seen an earnings recession yet. We really, really haven't. House prices are a little bit lower as a result of reduced transactions, of course. But there's nothing really saying to me right now, oh God, Armageddon's going to happen. And the main factor of this is that unemployment has not budged. I think the Fed are looking at things and saying, how the hell has unemployment not gone up from everything that we've done in terms of tapering, in terms of raising interest rates, all of these things, and unemployment hasn't budged? Because that is going to be a major, major factor that could crop up at any moment. I've been talking about it for a while, but we're not seeing it yet. If unemployment were to have increased, we'd have seen GDP at maybe 3%. We'd have seen a miss. But unemployment isn't going anywhere just yet. And it's a really, really strange phenomenon, actually, because usually with interest rates higher, you'd expect margins for businesses to thin, I guess, which would mean that they cannot pay employees, they'd have to cut. And we have seen some cutting in the tech sector. But the tech sector is not the real economy. They hired, thousands and thousands and thousands of people over COVID just because they'd made so much money. There was that excess bloat, and they just got rid of that bloat. So it didn't actually change anything really on the real economy figures, if you like. So we have heard of these cuts, but they aren't happening in the real economy. Now, anecdotally, I have heard of, tradesmen being cut from businesses and, fewer plumbers getting work and things like that. But I think there's still a massive hangover from the pandemic, which has allowed many people to still have savings that might be unaccounted for, let's say. There might have been a lot of jobs that were cash in hand. So the stats that are reflecting perhaps lower incomes or lower income quartiles, I don't think are necessarily reflective of reality at the same time. Another massive factor to do with this as well, especially to do with the retail sales numbers, is buy now, pay later. Now, in my view, I think buy now, pay later is not necessarily a bad thing if it's 0%, because all it's doing is it's acting as a tool for merchants to stop cart abandonments or basket abandonments. That's literally the main reason or the main selling point of these things. It's not so that people can actually spread it. It's actually so that, if they can increase, or decrease cart abandonment by 5 to 10%, they're going to make a ton more money. So that's really why they pay buy now, pay later firms to spread it over maybe 4 or 8 payments. I don't know how it works. I've never actually used it. But I think that's a massive contributor as well to why we aren't seeing, uh, even over the Christmas period, a decline in goods and services sales. I think that's a key component as to how the economy has changed as well. And it might just be, maybe not necessarily a key component, but definitely something that is keeping the lower income quartiles boosted and supported. So there's many factors here that are going into how the GDP is working. There's things that have changed since 2019, since pre-pandemic, and I think that's absolutely key. But going forward today, we have the PCE. So that is the personal consumption estimator, I think. That's what it is. I can never remember these acronyms. But here you go. The expectation is 3.5%. Previous was 3.7%. 3.5 and above, I think the dollar gets a little bit bid. If we get any higher than that, then I think it gets turbo bid. So I would be very cautious of further equity strength up here. I mentioned the Goldman piece earlier in the week, and that was to do with Scott Rubner thinking that the upside in equities was done. We're at the 2 standard deviation level on the upside trend line. And I think, if you look at that in conjunction with where the euro versus the dollar is, there's a good case for some risk being taken off the table. So just watch for any sort of print on 3.5% or above going into today. Now, I just wanted to highlight something that perhaps isn't spoken about enough, and it's the difference between looking at a price chart where dividends are reinvested versus where they are not. Now, many people look at the FTSE as a really boring index, and I think that there's tons of contentious issues with the FTSE that are really to do with the wider economy, such as the FTSE not having many tech firms. It's very legacy-based, oil and gas, minerals, mining, etc., etc. But if you were to look at the FTSE from just a perspective of how do you make money, imagine if the companies had, their names jotted out. You didn't know what sector they were in. All you had were numbers, okay? The way that you would look at it is the FTSE provides a fantastic dividend yield. But many people just look at the FTSE as being this boring index that just pretty much goes sideways. However, if you actually look at the FTSE with the dividends reinvested, it has returned a fairly large chunk. Actually, from 2012 to 2021, it returned 84% versus what it looks like of 24% when you just look at the price chart. So you have to factor in dividend yields when you're actually making a practical assessment of what you're putting your money into, because these things matter over the long term. And without them, you're never going to get the full picture of what's a good investment and what's not.